Hi, we've got in this segment Darius Dale, the founder and CEO and good friend of 42 Macro. It's an investment research firm that aims to disrupt the financial services industry by democratizing institutional grade macro risk management processes. Prior to founding 42 Macro, Darius was a managing director and partner at Hedge Risk Management, an independent investment research firm based in Connecticut. And there he was the sector head of the macro team and was a core contributor to the firm's economic outlook and associated investment strategy review. Obviously, I've known him for a while. Some of you who are 42 Macro folks see us together doing pro-to-pro Q&A all the time. And one of the things I love about Darius is a data-driven guy. We look through his data every morning, gain insights from him. So I'm super excited to introduce Darius to a broader audience today and some of our clients and prospective clients. Thank you, Darius, for joining us today.
Yeah, Nadine, thank you so much for the very kind introduction, and it's a pleasure to be with you and your clients, subscribers, everyone. We appreciate the opportunity here to talk macro risk management, because we think those things are very, very different.
Yeah, I'd love to, Darius, one of the things, some people listening are going to be familiar with your process and all the lingo, and other people are going to be new to it. And obviously we use it, so I don't want to be too familiar with some of the lingo. Can you walk through your grid framework a little bit, maybe some of the key risk management data points that you look at and talk, so that it kind of puts in context the discussion today?
Absolutely. Well, most people who know me know that I'm pretty good at math, but I'm excellent at nomenclature. I definitely can get. No, I like to sizzle it down. So let's get into just the process. I do believe it's important to spend a few minutes at the bare minimum talking about the process, what we call our grid regime process, because that's kind of the prism through which a lot of the analysis is performed. So let me just get right into it, introducing our grid framework. What we're looking at here is inflation on the x-axis and growth on the y-axis, and what we're trying to do is identify the trending rates of change of both. When growth's accelerating and inflation is decelerating, that's what the market calls Goldilocks. I didn't make that up. When growth and inflation are accelerating simultaneously, that's what the market calls inflation. That obviously has a side of it. So what we're talking about is risk on with a disinflationary bias, risk on with a inflationary bias. When you cross the horizontal axis, that means growth's decelerating. And you down here, we call inflation. Most people call that stagflation. We just call it inflation because grid sounds better than GRSD. Anyway, so that's when growth's decelerating and inflation's accelerating. Again, call that inflation. And then lastly, what we're down here, that's where growth and inflation are decelerating simultaneously. So obviously, when you're here, you're talking about risk off with a deflationary bias, and you're down here, you're talking about risk off with an inflationary bias. Sort of what we kind of experienced sometime this summer. Kind of getting into the process broadly, what we're doing is we're trying to measure and map. So measure backward looking and map forward looking the trending rates of change of growth and inflation for every economy in the world, or at least every what we would consider to be investable economy. And ultimately, we use that information to sort of anticipate changes in the market regime, what the market is pricing in. Because at any given time, the market could be pricing in Goldilocks, reflation, inflation, or deflation. Right now, on a trending basis, it happens to be pricing in reflation. That process really sort of kicked off in earnest this month. But prior to that, it had been pricing in inflation, really particularly from, kind of late July through the latter part of September through the early part of October. And so we're back in reflation. And the key question, obviously, is how long it can last. But going back to the process again, and we'll kick off the discussion on how long it'll last in a second. But going back to the process, there's kind of three core tenets of why we look at the world through this regime segmentation lens. One, we sort of stand on the shoulders of giants here. I'm a pretty smart guy, but certainly not as smart as these three amigos. You can put Tversky there as well. But the key takeaways here is that rate of change is what drives financial markets. The rate of change of growth, inflation, of policy things. These principal components of asset class returns are what create dispersion in and across asset markets. So that's what we have to measure and map. It's not the level; it's the rate of change. Number two, probability is more important than conviction. Understanding how probabilities evolve is a lot more valuable to you from a risk management perspective than just maintaining some static level of conviction whenever you formulate a theme or an investment idea. And then lastly, the godfather himself, Benoit Mandelbrot, volatility is a leading indicator for price. Almost always, whenever you have a big drawdown in price, it was presaged by a change in the volatility regime of the asset. So we're very big on scoring assets through the lens of what we call our volatility adjusted momentum signal. And so the second component of our process, because again, this grid here and this table is the bottom up component. What's the economy doing, and how's the economy likely to impact asset markets? The market observation part of our process is done through what we call our global macro risk matrix. Don't try to squint into this table. I'm just the key takeaways is what we're doing here is knocking on the door of the 42 most liquid, the 42 most widely followed markets in the world, and we're through the prism of our volatility adjusted momentum signal process, and asking it, hey, are you bullish or bearish, or are you neutral? And if you're bullish, you might be signaling Goldilocks and or reflation. If you're bearish, you might be signaling inflation or deflation. And then every day throughout that process, we add it up to understand which regime the market is currently betting on the most, from a probability perspective. And so that share of the total sum is what we consider to be the sort of dominant market regime right now. Again, I mentioned inflation at 47%. That's the highest we've seen since going back to the middle of May. And so inflation really kind of emerged from this muck, which was fundamentally driven, and we can unpack that as well. It's a reemerge from the muck back to where it had been back in May, and we ultimately think this green line has the ability to sustain itself at the top of the chart for at least another few months. We'll unpack that as well in a little bit. But again, as I mentioned, inflation is now the dominant market regime, as it had been really for most of November all the way through the early part of June. And then lastly, on the process, kind of just summarizing, it's not just enough to understand, okay, what is the economy doing in trending rate of change terms? What's policy about to do as a function of that? And then also what's the market pricing in, and using those economic projections to anticipate what the market's pricing in might change. We have to understand how things have historically performed in each of the regimes. So we back tested every single thing that ticks through the lens of annualized expected returns, volatility, covariance, percent positive ratios, et cetera, through the prism of those grid regimes, and we understand what's the appropriate playbook to put on as a function of that forecasting process. So that's kind of the process in a nutshell. Nadine, I can turn it back to you for any questions. Otherwise, I'll keep moving.
Sure, and I think that the kind of the summary of that, right, is you have the bottom-up macro. So you're looking at the data across these geographies, which you showed through the grid. You're also looking at the probabilities, because it's not just because if it shows a R or a D that it's 100%. You're looking at like how probable is that today and in the future, and that's key, right? And because we'll come back to grid zero in a second, but you're looking at those probabilities. But then you also looked at what's happening in the market. So the VAMs, the volatility adjusted signals that you've got, is to say, I know what we think things should be, but how are things actually trading? And are things either breaking down, breaking out? And that's helping you navigate some of the data you're seeing on the bottom-up macro side. So by putting that together, you're able to talk to, and then obviously your back test, which you mentioned, your playbook of like, given these types of situations, what should do well statistically, so that people can either position today for the right market environment, or tomorrow for what you expect it to be. So I know that you went through that like a king here and super fast, but I'm trying to break it down. Like there is a lot of good stuff in there, and that's how I would, I like to kind of like village idiot. Like how do I think about what you said in the context of, all the math, all the process that you have, what explains that framework? There's a lot there, and that's what I think helps you be right more than wrong. Is that you're kind of catching it on the bottom up, you're catching up what's actually happening, you're thinking ahead, you got your playbook, you're checking, is that playbook working or not? There's so many tools in the toolkit of your process and that framework that you're using to advise clients. So I do want to, put that out as the note to people, because it's really important to put all of those things together. Like, why are you doing those things?
Absolutely, and I think you hit the nail on the head with one thing you said, which is, we use all these tools to effectively separate our investment objectives and our investment themes from what's actually happening in the market, because that's where risk management lives. Risk management lives in the observations and the evolution of probabilities, and our expectations on the future state of the world, the future state of any bottom up investment is it's all fine and dandy, but sometimes the plan changes. I have this increasingly famous saying, but the trash cans move. That's a football reference, but the trash cans do move in real life, and it's ultimately up to our process to identify when the trash cans move. They moved in a material way in June, all the way through the lows of cyclicals in August from the reflation trade. And if you didn't understand that reflation was overpriced at this particular juncture, you wouldn't have realized that the trash cans are about to move. In so much that if you didn't realize that inflation is probably underpriced at this particular juncture, now that the world is emerging from Delta, you realize the trash cans are going to move. So it's our job to front run that process using economic data.
So maybe we can go back. You can show any grid, maybe the U.S., whatever you want to show. Talking a little bit about grid zero and the muck that we've seen, number one. So kind of, talking about what that's meant to the markets. You and I have talked on various occasions about how that's made it hard. You might see the S&P up a certain amount, but underneath the surface, there's been a ton of volatility, whether value or growth, certain types of securities, other types of factor risks. Lots of different volatility underneath the surface of the overall return. But then how do you think about today? So I know this past week, reflation has, obviously become what you have said is the highest probable current and near-term option. But looking ahead the next 3, 6, 9 months, maybe talk us through your view, starting with grid zero where we have been, kind of reflation where we sit now, and then where do you see things going forward and why?
Yeah, so that's a great question, Nadine. So, I think the first thing everyone sort of noticed as they look at this chart is that the forecasts are starting to cluster near the origin. I mean, we're coming out of a scenario where it was very obvious deflation, and as evidenced by the very obvious, very high conditional probabilities in that particular juncture, very obvious reflation, very hot inflation in terms of the deltas of economic and inflation activity in the economy. Now, in terms of what we're observing, both in real time, but also from a perspective basis in terms of our models, it's suggesting that we're not going to get a lot of delta over the next, few months, a couple of quarters. The deltas have really slowed down, and that's why we say it's grid zero as opposed to Goldilocks, reflation, inflation, or deflation. We're getting close to the origin, the 0 dots on these charts, and what that means is that asset markets are going to have a very difficult time pricing in one regime or another. Now, that doesn't necessarily mean that one regime might not get favored on a trending basis, as reflation currently is being favored. But what that ultimately means is that sort of the sector and style factor dispersion that typically occurs when you're in a reflation regime, right? High beta typically outperforms low beta meaningfully. Small caps typically outperform mega caps meaningfully. Value typically outperforms growth meaningfully. You're just unlikely to see that same degree of dispersion, of that same degree of leadership change with respect to a regime that is a lot less reflationary than it had been, going back to slide 24, a lot less reflationary than it had been in the early part of the year.
You and I talked about that a little bit, right? It's just that it was really different time, that reflationary environment. So maybe walk through people like, why is this R a little bit different than the spring R?
Yeah, so I mean, the key takeaway is that the spring R was driven by faster rates of growth, faster change in growth, and obviously much faster change in inflation. And now what we're talking about here, so right now the highest probability economic outcome, according to all the data that we load into our nowcast models for growth and inflation, would suggest that stagflation is the highest probability outcome for these couple of months. I have a fundamental view that reflation is likely to now cast itself into being the highest probability outcome. So what that ultimately means is that these R's right here, these modal outcome R's, are likely to transition to, or these modal outcome I's, are likely to transition themselves into R's. And I believe that's why the market has returned to reflation. Again, these R's from a probability perspective, it's a little bit harder to see now. These R's from a probability perspective are a lot less, aggressive than these R's, right? A very obvious string of accelerating growth and very hot accelerating inflation. And, we get this for a couple of months. It ain't that. I've been doing this joke for a while now, and I'm sure people are sick of hearing it, but, it's like we have the Jackson 5, creating this sort of big run up in nominal and real interest rates in the first part of this year, in the early part of this year, really contributing to one of the worst years in the bond market ever. And the reason I say Jackson 5 is because we have 5 things perpetuating that almost never happened. There's only been 10 quarters since 1960 where growth was accelerating markedly, inflation was accelerating markedly, corporate profit growth was accelerating markedly, monetary policy was easing markedly, and fiscal policy was easing markedly. It's 10 quarters since 1960 where that was happening. And this was obviously one of those periods in time. And that's what created the duration risk that we called out, going back to last fall. Well, we're obviously seeing a little bit of duration risk reemerge in the markets now. But as we can see, particularly in the long end of the curve where we experienced a decent amount of flattening, it just isn't the same trade. This is just not the same trade. So that's what I mean by grid zero. And ultimately where this is really going is from a portfolio construction perspective, instead of having this circle, because what we're trying to do is use our expectations for the bottom up macro economy and our current nowcast for the market regime to understand how big should each of these pies be. Like each of these pies are
Right.
reflective of one of the four grid regimes. And if it's November 2020, this whole pie should be lime green. November 2021, I would argue the whole pie should not be lime green, even though reflation might be the dominant regime. You certainly need to have some anticipation of the pending deflation regime that we see coming in the first quarter. You certainly need to have some protection with respect to the stagflation risk that is still very much present on the table when you look at the conditional probabilities for both the U.S. and the global economy. And then lastly, if inflation starts to check back in because we start to see an amelioration of supply chain pressures, you actually could get a market that trades a little bit more like Goldilocks, as it has over the past week or so. And so that's why the portfolio construction is balanced, because the economy, the signals that the markets are gleaning from the economy right now are fairly balanced in their own right.
Right. And so maybe take us back to the one of the grids, so any of the grids, so people can kind of see what we're talking about here. So why is Darius's portfolio construction spread across some of these regimes is that that's clustered near the axis, so the XY axis, and you're not pulling away from it. We've had a lot easier time when it's further away, especially when it's moving, call it from, one grid to the next grid. It's because then you can position ahead of time. Capital has to move, let's say they were in stagflation, they have to move from stagflation to reflation. So you get paid when the capital moves to you. And, obviously that takes a little bit of time. And so you can get paid that way, in addition to be just paid to be in the right place at the right time. But when you're sitting at that grid zero, it's really hard because it's like switching all the time. So, your portfolio construction has been much more measured across the grid because you're sitting in that, and you've seen week to week, month to month, from stagflation to reflation, a little bit of Goldilocks, like it's all over the place, right? And so I think it's important for people to understand that, and which begs the question, looking at all the D's coming up is, how long are we going to sit in this grid zero, right? Before we can actually take a stance, or like what signals are you looking at to be able to say, yeah, we're heading into that, you need to have more defensive, and we happen to know what that is, what that means: low beta, low leverage. You might be going to gold, might be long the dollar. There's, you can go long duration. There's so many different ways you can play it: utilities, staples, bond-like securities. So there's a whole shift you make if the world is going into the blue D's. Help people understand what are the types of things, what are the signals that you're going to be looking for to be able to advise your clients on making that transition.
No, great question. So I'll answer that. I just got one final thing to say on the primary point, because you brought up a really interesting point and really important point. The further you are from the origin,
yeah,
the easier it is to risk manage. I don't care if the market is crashing or going up by 20%. That's the history of asset markets, and that's really that's all over our back test. If you're further away from the origin and you're in Goldilocks, the market will look exactly like Goldilocks. So the closer you are to the origin, the less likely it is that sort of historical sector and style factor leadership in the equity and fixed income markets holds. So that's
the playbook is not as strong, right? Right. The playbook's not as strong.
Exactly. But so going to your question, I do believe that this sort of reflation regime, from a market perspective, has the ability to transcend itself well into the first part of the year.
Okay.
If I had to, put a Tiffany box on it, I'd say it probably peaks in January sometime. But again, we'll check in with me then. Check in with the
subscribe to Darius.
Yeah. So I'll give you a few charts on that, on why I believe that. What we're seeing now is a real breaking down of long-term realized volatility, and there's a lot of volatility targeting funds that tend to chase as a function of that. Their capital allocation to equity markets, to risk assets, tends to rise whenever you get these sort of breakdowns in volatility. Particularly, I know a big firm starts with a C, based out of your hometown, Chicago. They like to look at the crossover between 6 month and 1 year versus the crossover between 1 year and 2 year realized volatility. So I'm using this kind of as a proxy for that. And typically, what you see is you get these sort of final last gasps higher historically, and I believe that's kind of where we are today. We're likely to see this like final last gasp higher with respect to people's in respect to other investors increasing their leverage with respect to the equity and credit markets. On slide 39, obviously we have this sort of kind of debt ceiling issue drama, if you will, and the sort of budget resolution. But the reality is, from a market catalyst perspective, you have a 2/3 chance of winning. And what I mean by that is it's very likely you see something. I mean, it's very likely you get
something good.
Yeah, you're going to get something good. It's going to be some physical infrastructure. It's going to be some budget resolution. It's not going to be $3.5 trillion. We know that. It's probably going to be haircut by $2 trillion at the bare minimum, or at the bare minimum haircut by $1.5 trillion. At the maximum haircut by $2 trillion. They've already settled on $2 trillion more. It looks like. So the real bear case was that the Democrats, who were in control of the or both houses of Congress and also the White House, can't figure it out and just hand the Republican Party the midterm elections next year.
Right.
I think that's a low probability event. In fact, anything, I think 32% is probably being kind to the behavioral aspect of that also. You have a positive catalyst coming in December as well with respect to the market. And this we know. Investors have near record amounts of cash on hand. This is ICI money market fund assets at $4.5 trillion. Obviously hasn't really budged much since the early days of the pandemic. And the reason it hasn't budged much, it's not because investors are too concerned about stocks and credit. It's because they're freaked out about bonds. You typically don't see high levels of cash with, low financial conditions indices, which means financial conditions are easy. You typically see this, that's more indicative. And so if we start to see a year-end rally brought on by more, these types of investors increasing their exposure to the market, you could actually get more fundamental REA type investors increasing their exposure to the market. And oh, by the way, this is probably one of the more important charts in the deck. We've been talking about tapering ad nauseum for months now, but the reality is net liquidity supply is going to continue going higher, at least through the early part of next year. The only thing that's going to keep that going, because we know the Fed's not going to go from 120 billion a month to 0 billion a month.
Right.
It's going to be a gradual process. We're obviously all market expectations are centered around 15 billion a month. I'm not smart enough to have a differentiated view on that. We'll check in with Jay Powell next Wednesday. But the reality is this line is going to continue to go up. And as long as the line continues to go up, albeit at a logarithmic pace as opposed to an exponential pace, the red line is likely to continue to go up. So the only thing you have to answer as it relates to what will be the catalyst for the D's to really start to get priced in, those D's in terms of deflation in those tables, what will be the catalyst? It'll be the return of the bully, in my opinion. It's so that this blue line here is showing the Treasury cash balance at the Treasury general account, and the red line is overnight repo. So obviously when they pass the budget resolution, it's very likely from a behavioral perspective that the Democrats want to get dollars out the door as quickly as possible, so that when they're on the campaign trail on Valentine's Day, because these things get earlier and earlier every year, on the campaign trail, they'll be able to say, hey, look at what we did for you. We just got this passed, and we got these checks coming to you, and child care service. We got all this good stuff coming to you. So they're going to front end load a lot of the debt issues.
Right.
That. The reality is that's not going to be that bad, at least initially, because you have a $1.4 trillion sitting in overnight repo waiting for a home on the short end of the curve.
Right.
Treasury bill issuance. The issue for asset markets is when that process goes. When this 1.4 trillion gets back down to here, and they're still raising debt, that's when this sort of QE game that we've really come to enjoy and love really since the early days of the pandemic, that's when that net liquidity spigot might turn off. And my expectation of that sometime in mid to late Q1.
That's really helpful. And maybe go back to the cash chart, because you had so many nuggets in there. So I'm trying to pull out the nuggets, but one of the nuggets was about the cash sitting on the sidelines hasn't been about the equity markets as much per se as it has been about the bond markets, right? And so one of the moves, and we talked about this yesterday, to make is that once you have a little bit more certainty on timing of that sea of blue D's across the world, is that people aren't, terribly long the long bond, or, and so, and you get paid for obviously then being in the right grid at the right time, but also the capital moving your way. And so, one of the things that I like about your data-driven research is it doesn't just give you the playbook of where to go, but also like how strong a conviction, or what could really be moving that in a way to you to kind of like make double your money. And that's the kind of thing where you can have a high conviction bet on that. You may not have to get the timing perfect on that. If your rates are up and you're going to be staying in a zone for a little while, maybe in this 1.7s. For a bit, but then you could make a lot of money into 2022 if you actually see, GDP growth decelerating, people coming to that view a bit more, and then bonds reacting, accordingly. And I think the trick, which your point is like, what's the timing of that? How do you make that happen? So I think that, watching you every day, getting your data is very helpful because it helps people like us understand, when do we start to position those portfolios?
Yeah, that's a great segue. Going back to the comment you made on bonds, and so I do believe that this is a lower high. I don't know. I don't expect 30-year Treasury bonds to do this in any near term. I believe the next big move in bonds in bond yields is likely to on the other side of all of these we're talking about.
Yeah.
Again, if markets function on rate of change, it would be disingenuous for me and actually most investors to say, hey, growth and inflation are going to decelerate substantially over the next 12 months, but for some reason I expect bond yields to be up. That's not how markets work. So obviously, I think the bond market gets the joke, particularly on the long end of the curve.
Right.
Part of the reason it gets the joke is because it understands what this ultimately means right here, this blue line. I mean, this is one of the freakiest things I've seen, quite frankly, in my career, in terms of the speed with which the market is pulling forward policy rate tightening into 2022.
That was going to be my next question to you is what stops a party like this is it's if you have tightening ahead of time, right? And so especially if you're going to be heading into a sea of deflation, blue Ds, you don't want that to be front run by tightening because then it just exacerbates the situation. Maybe walk through a little bit about, what are your views on that as a possibility? What are the things you'd be watching for that might, heighten your worry or ease your worry from that perspective?
Yeah, so let me start with the base case scenario, and then I can go with both the bull case and the bear case. So the base case scenario is very clearly that this is being rewarded well by markets because stagflation is actually the key downside risk. The market actually wants the Fed to sort of not necessarily in the QE game, but certainly get a little bit more serious about their ability to combat inflation, later in the cycle or earlier in the cycle than they have been previously sort of guiding towards with respect to the forward guidance. And so we've seen, since the September FOMC, we've seen the market's expectation of for, the amount of rate hikes that we priced into 2022 effectively back up by 50, 60, 70 60 basis points. I mean, that's a pretty meaningful move.
Yeah.
Huge move. And more importantly, it's come out of 2024. And now it's actually starting to come out of 2023. So what the market is effectively saying is that inflation is likely to be persistent, and it's likely to have catalyze a sooner start to the tightening process than had initially been anticipated, and ultimately that sooner start to the tightening process is having market implications on the curve. The pink line in this chart, so let me delete so you guys can see it.
So is it too early now to position for long dated treasuries and the like, or because we're in this reflationary mode, or how do you think about timing for that type of move?
Yeah, so I do believe you're probably going to bounce around here. Maybe you threaten to here, but I think all dips are going to be bought in bonds. And part of the reason for that is one, this is one of the worst years in bond market history. So the closer you get to the end of the calendar year, you're going to see pension fund rebalancing. And so I don't know that we're going to break through 180 or
you got a floor.
I think this is a hard top for bonds. And if anything, we bounce around and then down. I think the 30 years probably put in its lower high. The 30 year, I mean, if it's going, that's why I brought up this chart, which is we're seeing massive yield curve compression. This is the 5-year, 30-year spread. The 10-year, 30-year spread looks the same. The 2's10 spread's not quite as aggressive, but it's obviously moving down as well. And I think that's the bond market effectively. The bond market is seeing what we see with respect to our projections, which is the U.S. economy and really a large swath of the global economy are likely to be in bottom-up macro regime deflation for really the balance of 2022. And again, that means growth and inflation are trending lower, throughout. And not just trending lower, trending markedly lower in some cases. This is our U.S. Growth forecast here. So you're going to have a pretty steep deceleration starting around mid to late Q1 and the early part of Q2. You look at our inflation forecast on slide 43. And slide 43, you got inflation coming down a whole heck of a lot. I mean, right now we're kind of at the peak of the sine curve into inflation, which is why the market is so angsty about pulling forward those rate hikes into 2022. Right. But eventually, I mean, you're having this conversation a year from now. Inflation is going to be a lot lower, and we can actually open that up to the whole persistent versus transitory debate because that's obviously something. Yeah.
I think I'd love to tackle that, and then a last topic of China. But maybe talk a little bit about the, is it sticky but higher? Is it transitory and it's coming down? What's your view on inflation? And because it's kind of related to that, like what's going on with China, and if it is going to eventually accelerate, and how long that's going to take. what does that do to inflation calls? What does that do to the type of growth you're going to see around the world eventually, maybe?
Yeah, absolutely. So right now, China has been fairly disinflationary for the world in a time where there's a lot of inflation pressure. So we can thank China to some degree for providing us that relief to some degree. But kind of going back to the inflation persistent versus transitory. This kind of I'm in both camps, and I'll fly through these slides, so you can ping me on Twitter or anything if I go too fast here. But the reason I say both camps is because on a rate of change basis, inflation is going lower. I think that's a very high probability event, and I'm certainly not alone in that view. But what I mean by persistent is I think this sort of stationary mean that we kind of grown accustomed to in recent cycles. I don't know, we'll call it 1.5 to 2%. The market is oscillating around that mean. I think the stationary mean is up 100, 150 basis points over the next few years. And that's what I mean by we're likely to experience persistent inflationary pressures. I'll unpack the transitory part of that. So on the transitory side, we haven't had, obviously demographics haven't changed, both, for the developed market economy and the global economy. You have things like demographics I mentioned. That's the labor force participation rate, dragging down money velocity, technology, or the advent of technology, looking at the market cap of the NASDAQ 100 relative to the Russell 3000. And then you have globalization here too, in terms of the imports of goods and services percent of GDP. 3 of those 4 things actually got more pronounced than COVID. You know what I mean? So in terms of, you have to make it very, forces are actually ironically stronger in COVID for disinflation. Obviously, we've got the sort of the monopsony power. This is S&P 100 market cap over S&P 500 market cap, and this is employee compensation relative to CapEx. And so between these 2 charts, you have to make a credible case for why inflation is going to be persistent, not just looking at what's been reported, but you have to make a forward-looking case about why inflation is likely to be persistent. In terms of why it may be persistent, I think there's sort of a couple things. One, we're seeing the inflation pressure broaden out. This is median CPI that's up 5.57% on a seasonally adjusted annualized basis. That SAR figure, that growth rate, is actually the fastest we've seen since August of 1990. So that's a pretty clean-cut indication that it's just not the pandemic stuff, going back.
Right, it's everything.
It's not like used cars, which are up 200%, now they're down 8% annualized. It's not just, hotels, which are up 150%, now they're down 7% annualized. It's not just airfares, 200 to minus 55. It's a lot of other stuff. And one of the big other things is this relationship between home price appreciation and shelter. The blue line is home price appreciation, up 19.8% year over year in the most recent month, I believe August. That's the highest we've seen ever. This is OER, owner's equivalent rent. It's a component of the CPI basket. It's about 75% of the shelter CPI, which itself is about a third of the overall basket. The reason I show this diagram in this way is because whenever you've seen a pretty material spread between home price appreciation, a cyclical peak in that, what you've seen is subsequently, 18
rent's going up, right?
of owner's equivalent rent going up. So that repricing process takes a long time, just based on the funky way that owner's equivalent rent is calculated. But what that means is that a lot of stuff is going to be disinflating over the next 12 months, but a big part of the basket is actually going to be moving countercyclically. And so that's when you can get the stationary mean of the time series transposed higher.
And so what does the Fed do with that, right? Is that that's one of their mandates, is obviously to deal with inflation, but it's also the labor force and the inclusiveness, if you want to say, of that labor force. So how do investors think about the Fed's reaction when they've got a few different things that might not all be moving in the same direction?
Appropriate question to take, right? So going back to to kind of looking at markets through the lens of the bond market, then I'll answer the question through the lens of the labor market. From basically August of last year through June of this year, every investor in the world, either implicitly or explicitly, had begun to believe that the Fed had adopted a monetary theory framework. If you add up at average inflation targeting and maximum inclusive employment objective, you put those 2 things together, it just screams MMT. Now they're not going to say MMT because that's a bad word. It's a policy about central bankers at the current juncture, but they certainly thought, the market reacted to the Fed as if it were MMT framework, signing some pretty wacky multiples to, formerly beleaguered value stocks, things of that nature.
Right.
In June, that June FOMC event, which is one of the most important macro catalysts of the year, that their dot plot revision was the first signal since going back to August of last year that they had not adopted an MMT framework.
Right. We're willing to move the rates up. Right.
They actually care about. And so, going back to, the labor market, you have these shortfalls in employment. This is the employment to population ratio is still down 240 basis points off its pre-crisis peak. You have the prime labor force participation rate still down 140 basis points off its pre-crisis peak. And so you look at things like that. You look at the 7 million Americans who are out of work, between the 2 million unemployed and the 5 million who left the labor force altogether. And then lastly, you look at the dispersion between the improvement or the degradation in the unemployment rates between ethnic groups. This is the white unemployment rate. It's only up 120 basis points off its pre-crisis peak. But then you look at the Hispanic and African American unemployment rates. Obviously, the pandemic's been a lot more challenging for those particular demographics. You're still seeing a lot of dispersion. So when you're Jay Powell and you're sitting around the table at the Equities building, you have to acknowledge the fact that there's a tremendous amount of current inflation pressure in the economy, but you also have to be cognizant of the fact that with respect to your own stated objectives, you are still very much behind in terms of achieving those mandates. And so I do believe it means that this Fed is very unlikely to, kind of jump the gun. If anything, the euro dollar market, in terms of pulling in all those rate hike expectations into 2022, might actually be jumping the gun for the Fed as it looks around at, median CPI kind of stuff like that, looking at the Dallas Fed trim mean. I think investors are appropriately concerned about inflation pressure, but might ultimately be mispricing the pace and timing with which the Fed is going to react to that. And obviously that's bond bullish as you get further out in time.
Right. Well, we could go on forever, I know, because sometimes we do. But thank you so much. A good friend, one of the hardest working people on Wall Street, founder and CEO Darius Dale of 42 Macro. You heard it here. His views on China, inflation, GDP, the Fed, what they're going to do. There's so many things we've talked about today. Grid zero, pulling out of that to reflation, thinking about the statistics around that. So many exciting things to talk to you. And I love, again, Darius, is that you're data driven and you're willing to every day be looking at that data to help people like us navigate the markets and obviously navigate the macro factors as well. So thank you so much, Darius, for your time today. And we look forward to talking to you soon.
Absolutely. Thank you, Nadine. And thank you not only for inviting me here, but you're a fantastic leader for female participation in our industry. You obviously been flying that flag for a long time, and we're really proud of you for what you're doing as well. So thank you.
Thank you, Darius. All right. Well, have a great day.
Cheers. You too.